All right, so that's views across asset classes. Abhilash Narayan is Senior Investment Strategist, Group Wealth Management at Standard Chartered. He's joining us right now to take some questions. Abhilash, great to have you with us here. Thank you very much for your time. How are things looking? Global market fragility and general very strong momentum here in India. We were just discussing, I don't know if you heard, what happened on Friday. We had that 50 basis point hike by the RBI, and the market, I mean, just fine. I mean, did actually very well. Your sense on things from here?
Well, absolutely. If you look at the global markets, clearly there are a lot of concerns. And if you look at what happened on Friday, yes, consumption data in the US was good, but I think the key focus for the markets was the higher than expected inflation, not only in US, but also in Europe, where inflation touched 10%. And what that means is that it just keeps the central banks, on the path to keep hiking rates to tackle inflation. So I think the stock market reaction that we saw, especially in US on Friday, was a reflection of that acceptance of the fact that the Fed will keep hiking rates, and that at the margin will continue to be, a headwind for global equity markets, at least over the next 1 to 3 months.
Abhilash, hi, good morning. What about all the news flow on Credit Suisse? Do you think that could prove to be a layman moment for global markets, or is that unwarranted, the concern there?
Well, we think that, individual banks can face some challenges from time to time, and it's not the first time we've seen any particular European bank facing some scrutiny, right? We had that with German banking sector in 2016, 2017. We saw concerns around Italian banking sector a few years back. So this is not something which is unheard of. And if I look at it, European banking sector, and for that matter, global banking sector, is now in a much, much better shape as compared to 2007, 2008. If you look at capitalization levels, they are much higher. If you look at buffers that have been built in, both from a regulatory perspective, they are much, much better. So we think that, while you could have concerns around individual banks, the broader global banking sector, especially European banking sector, should remain broadly, okay. So we are in fact bullish on European financials, because we think that the fact that ECB is hiking rates will mean that the net interest margins for European banks should improve going forward. And while loan losses could increase at the margin, we think that when you think about the valuations that are there, the tilt that you have towards value-oriented sectors in global investors, mindset, asset allocation right now, all that means that European banking sector as a whole should be okay and actually should outperform the broader market.
Abhilash, good morning. So this Indian market outperformance and resilience, do you think that continues given the inherent strengths or the data points that we have in India?
Absolutely. So, we have been bullish on Indian equity markets for the last 3 to 6 months. And it's played out as we expected, right? And the key drivers that we have been highlighting haven't really changed. So obviously, India, as we all know, is expected to grow much, much faster than the rest of the world. Yes, RBI did reduce the FY23 growth forecast from 7.2 to 7%. But when you think about it in the context that growth expectations in US for 2023 are less than 1%, for UK, growth is expected to be negative. And in China as well, growth recovery is expected to be slow. So India really stands out as being a high growth market. If you look at equity earnings expectations, we expect around 16% EPS growth over the next 12 months. So that's, again, substantially higher than what we expect elsewhere. And if I look at the monetary policy, yes, RBI did hike the rates by 50 basis points, which was not expected, let's say, a couple of weeks back. But when we think about the inflationary pressures that we see in US and Europe, compared to that, India is still in a relatively better position. So the risk that RBI over tightens and, slows down growth is much, much lower. So we continue to think that Indian equities should outperform. That being said, obviously, valuations, the elevated valuations are sort of a risk. But, if anything, that will be responsible for short-term volatility. But on a 12-month horizon, we're still bullish.
You're still bullish. So, just any thoughts, Abhilash, you can offer on what we are seeing in the technology space, and whether some of that will continue, or especially in tech, things are coming close to kind of bottoming out. I'm talking about US tech specifically. If there's a house view or something of that sort, yeah.
Yeah, so I think we are neutral on US tech at the moment. Now, US technology sector is facing two sort of conflicting factors right now. On one hand, obviously, if you look at the earnings growth for US tech sector, that still remains fairly healthy. The companies in the sector, by and large, when you look at it from a market capital perspective, are cash rich. They are quality companies. If you think about the likes of Apple, Google, the FANG stocks, right? But on the other hand, obviously, rising rates are a concern, because one of the things that people look at when looking at technology sector is they look at it as a long duration bond, because most of the cash flows for technology companies are expected to happen further down the line. So if bond yields increase, the discounting rate also increases, and that means that the impact of rising bond yields is more on the technology sector as compared to, let's say, a value-oriented sector like energy sector. So we think that the sector would underperform in the next 1 to 3 months, given just the momentum that we've seen. But on a 12-month horizon, it should broadly perform in line with the broader US equity markets.
Back home in India, the consumption trends are picking up definitely, not just with the auto sector, but you also have air traffic coming back in a big way. There's infrastructure activity picking up. You know, the medium and heavy commercial vehicle space is back. Do you think these are spaces, the domestic focus sectors, that will continue to attract attention? And hence, would you be pro-domestic, and would you think that some of these export-facing sectors like IT perhaps could move to the back burner?
Well, within India, we think that at a headline level, we have a preference for large cap over mid cap and small cap stocks. But from a sectoral perspective, yes, absolutely. We have been highlighting that we prefer companies and sectors, which are likely to be direct beneficiaries of the infrastructure growth revival. And it's something that we've been highlighting for the last 3 to 6 months. So absolutely, we think that both sectors are likely to continue to do well.
All right, Abhilash, we'll leave it at that. Thanks a lot for joining us, and have a great day. Well, that's the word coming in from the investment strategist at Standard Chartered Bank, who says that India is in a much better place. Although the RBI has scaled down its GDP estimates, but at 7%, we're not half as bad as what other countries are doing at the moment.